Hi guys and welcome to Common Investor. Today some major news broke. Workday will be entering the S&P 500. Today we're going to evaluate and see is Workday a good long-term investment. Now I do want to emphasize one thing. Once a company enters the S&P 500, it has a 20% jump within its first year of entering. But that's not what we care about. We want to know, is this a good company to buy long term? Meaning, can we buy this company and now worry about it until 2030? That's what we want to know. So today we're going to run some numbers and see where it is positioned in the market and amongst its competitors. So the first thing I want to emphasize, the minute this news broke, it had an over 8% jump. So it was selling at 146 beginning of the week to now selling at 166. So right off the back, its current PE, that's very, very high. It's at 44. But if you look at its PE without one-time expenses, and I'm guessing this is mostly due to AI-related stuff, I haven't done a full investigation on this company, but that's been the common thing amongst companies of this type of nature. So 38 is not bad. It's pretty much what the average is right now for a tech company in this bubble market. But if you take a look at its forward PE, that's a bit attractive. I like that. I like seeing about 32, especially you're going to find out its growth. It has a very explosive growth. So seeing the fact that it has a 30, almost 32 forward PE, meaning what's its PE going to be from 12 months from now, I like seeing that. I like seeing that type of a number. Now we go to look at our revenue. Now, revenue is absolutely beautiful. If you go 5 years ago, it was making 3.2 billion, we'll say that, to today making 7.8 billion. So it had a massive run up. Look at that, massive. That's almost a 4x jump in revenue. However, you are seeing a bit of an issue when it comes to growth. For the last 5 years, even though its dollar amount of growth has been consistent year on year, its percentage of growth is starting to slow down, as you can see right here. Now, when you take a look at the actual numbers, something's very odd. Like, I never really noticed about any other company, but this one, it grows at a pretty consistent basis. Like, you can see it goes up 200 million every quarter for the last 5 years. And then you can just keep seeing 200. So as a company's revenue starts to get bigger and bigger, its overall percentage of growth starts to decrease. In my opinion, I rather see this than see straight up no growth for any given period of time. I like seeing this slow growth pattern. It makes its revenue more predictable for the future. Next is its number of outstanding shares. It has had a massive run up in this number. In the last 5 years, it has grown this number by 20%. Now, again, I feel like this is due to them expanding, and now we're going through this new AI boom to stay competitive within the market. I do expect this number to increase in the next 5 years, but not by 20%, but rather 5%, because I believe in the future, it will start doing stock buyback, but in the next immediate future, I mean the next 2-3 years, it's going to do more stock dilution. And then when it gets to that like 2027, 2028, period, is going to start doing stock buybacks, giving us that 5% average that I was talking about. Next is profitability. That is beautiful. It really is 17%. Now you have to understand this. A lot of this is because reinvesting all this money to stay competitive within the marketplace. When it wasn't reinvesting, its profit used to be 90%, it's 40%. Now you can see as time goes on, as it gets more competitive, as it starts to compete with more people, it's reinvesting all that capital. Look at it, it's reinvesting everything. So I like seeing this. I believe this will be 30% by 2030. That's my belief. EPS is one of the most beautiful things I've ever seen as well. Profitability was straight up negative for majority of the last 5 years. As you can see, negative. And then in the last 3 quarters, it's jumped up. See this right here? That's a jump. That means it's profitable now. It's no longer this company relies on debt to keep its operations functioning, but rather it's actually getting a profit that it can use in the future to do stock buybacks or potentially even do acquisitions. This is a turn for the best. Now we're going to see if this company is actually worth investing in and where we believe it will be in the next 5 years. Now we plugged all these numbers in already. Its revenue, number of shares, its PE, and its profit margin. So in the next 5 years, I'm expecting this company to hit a $15 billion in revenue. Now, if you look at analysts have it above that rate. So most analysts are saying that it will be around 16.3 billion by 2030. I don't believe that. I think it's going to be 15 billion. So we're going to say it's going to have 100% growth in the next 5 years. And plus, this is a good way to keep a margin of safety as well. Shares outstanding, like I said, I think that's going to increase by 5%. PE is going to be 30. That's going to go down. There's no way to sustain a 38 PE. And profitability, that's going to be 30% in my opinion. I don't think it's going to be at the 17.5% it is right now, because they're just reinvesting everything to stay competitive and to build out infrastructure that they need to be resilient when competition comes along in the near future. So when we plug all these numbers in, we are expecting this stock to be worth $502 by 2030. You're doing about 40% better than the S&P 500. So if you invest that same money into the S&P 500, your return will be $400. So you're beating the S&P by 39% by investing in this company. In my opinion, this is a very conservative outlook. I think it can go higher. I don't think it's a possibility that it can go lower. For me personally, I'm not investing in it yet. I want this stock to actually drop below 250 or 240 for me to jump in. Now, for us to make sure that this company stays on track and make sure we get the return we want to take a look at the expected revenue for the next 5 years. Now, it won't be a consistent line. Some years it will outperform, some years it will underperform, but we want it to stay on that average. So by 2025, it should have a revenue of 9.1 billion, then 10.4. If it stays on this track for the long term, this is a hold for the long term. But if it starts to fall off, if revenue starts to shrink, let's say by 2028, instead of doing 13 billion in revenue, it reports like 11, then that is a matter of concern and something we will revisit and potentially think about selling this company to look at a better opportunity. But this is what we're expecting for the next 5 years. We're expecting a growth of almost $1.5 billion every year for the next 5 years on a consistent basis. Now, we were going to talk about, like I said, we're going to talk about its place in the market. Now, I was expecting more of a dominant position, but unfortunately, it doesn't have that. It seems like Microsoft is its biggest competitor and it's right on its heels. So there could be a situation where Microsoft overtakes this because they have a lot of capital to spend. So, I mean, we also have Paycom, that's also a competitor. And then you have rest of the market, meaning others, that own more than 60% of the market. So that is a bit concerning. So it is, even though it has a great moat, it is in a highly competitive industry where it doesn't have that much leverage compared to its competitors. With all this being said, what do you guys think? Do you think this company can reach a $15 billion in revenue? Do you think it's going to underperform that amount? Or do you think Microsoft overtake it, can be a target for an acquisition? Wherever it is, comment below, let me know, and please like and follow. That helps out the channel a lot, and consider subscribing to my Patreon. I'll catch you guys in the next one. Peace.